Oh, Cathie Wood, you are the goddess of investing. Your ETFs are gonna go to infinity because I watched a YouTube video from a 21-year-old with a bachelor's degree in history. Welcome back to Strongman Personal Finance. I'm your host, Christopher Bell, and today we're gonna talk about the ETF ARK that is run by this woman on the screen right here. Her name is Cathie Wood. And yes, I just realized that I spelled her name wrong in the search results, but it still brought me up the correct person, okay? This is Cathie Wood. She manages a couple actively managed exchange-traded funds that are investing in disruptors, things that are going to change the future, like Tesla and genomics and things like that. That is what she focuses on with her investment team. And she manages a couple ETFs, which are exchange-traded funds. Now, recently, well, I guess in the past couple of years, she's been pretty big on the news. She's well known for making this prediction that Tesla, my favorite company, will have a stock value of approximately $4,000 one day. And that's pretty extreme, but then again, it's very possible. Now, my advice to you when it comes to investing in her ETFs is to not do it unless it's 5% or less of your entire portfolio. And the reason is because any ETF, any exchange traded fund investment or whatever that you see is hyped up and you see that everybody is starting to recommend it, it's probably in some kind of bubble or it's merely going up simply because of speculative return, not because of any earnings growth or, good financial things that have been coming out about the companies that the ETF is invested in. Remember, one of the key rules of investing is that stocks don't always go up. They actually go down. And stocks rotate. Some sectors do good, other sectors suck, and then 10 years later, they reverse. That's how it works. So when you see an asset class that is outperformed, you may have the temptation to invest in that asset class because you look and you're like, wow, this mutual fund did way better than all the other ones. And you kind of extrapolate that and think that is what's going to happen in the future, which is not necessarily the case. As a matter of fact, if you look at research, the majority of the time, hotshot mutual funds that have had a wild run over the last 10 whatever years, they usually underperform the index and their peers going forward. And there's a couple reasons that happens, which we'll discuss in another video. But the key thing is you don't want to chase performance. You want to look at the entire history of investments as far back as you can go, and you'll begin to realize that sectors rotate. Sometimes large cap does good, sometimes small cap does good, sometimes international does good, sometimes emerging markets does good. And that's fine. But you have to realize that you cannot invest simply based on recent past performance. And that includes the ARK ETF, which we're going to talk about right now. Now, I'm on a couple forums, not chat rooms, but like Facebook groups and on Reddit and all that. And all I hear about is ARK, Cathie Wood, ARK. Everybody's talking about them. When somebody asks a question and they're like, hey, what ETFs are you investing in? Everybody's like, oh, it's ARK. I'm in ARK, bro. 100% ARK. Everybody's in ARK. Everybody's talking about that. And what do you think that does to the underlying or the price of a stock or of an ETF? If everybody's talking about it and it's had huge past returns, which aren't guaranteed to go forward, and everybody thinks they're going to have these massive gains, don't you think there might be a lot more demand for those shares for that ETF? Yes, that's exactly what happens. The more hype, the more gains, the more people talk about it, the more they buy the ETF, simply because they expect it to perform in the future like it did in the recent past, which does not necessarily work. Now, you might get lucky and you might do great going forward. But think about it. If you're buying at a high, you're probably buying at a high, if that makes sense. If the stock has skyrocketed recently and it's as high as it's ever been and it's had outrageous returns, you're buying high if you start buying into it. Now, if you see an asset class that has done bad, Let's say international, which has done, not too well the past couple of decades, that's kind of at a low. But ARK, it's pretty high. And we're going to go into it, okay? So we have ARK Innovation ETF, which is I guess it's a large, mid, small equity growth ETF, all right? So it's actively managed by Cathie Wood. So it doesn't track an index. Her management team and her actually pick the investments that go into this ETF. And then people go ahead and buy the shares, either from other people or authorized participants. Now, why am I not a fan of this ETF right now? Do I think some of the companies in it are really great? Absolutely. Do I see long-term potential? Absolutely. But if you're looking to make a quick buck in the short term and you're not prepared for insane volatility, you're going to get screwed investing in this ETF right now. You want to buy an investment at a good price. It doesn't matter how good the company is. You want to get the investment at a good price, looking at price to earnings ratios, price to books, price to sales, PEG ratio. You want to look at all that stuff and see if what you're buying is actually a good value. Because you could buy the best company in the world, but if the price is 5 times what it should be, you're probably in for a world of hurt if there's a correction, because that price is pretty freaking high. All right? And that's what I think is going on with ARK right now. Now, if you look at the recent performance, over the past year, it has had 152% growth. 152%. And if you go back 3 years compounded, 52% per year. 5 years, 45% per year. What do you think that means? Well, we just talked about it. When people see that, that's like an insane growth. And people think, well, if that was in the past, it must be the same in the future. And they start piling in. And that kind of becomes a self-fulfilling prophecy because the price of the ETF and the underlying investments increases as there's more demand. So people are piling into this, and they've been talking about this for a while. Piling in. All right? Now, what is this invested in? Let's look. Tesla, 10%. 10% of this portfolio is in Tesla. I harp on Tesla all the time. Tesla, I believe, is in a massive bubble. I could be right or I could be wrong. I'm not perfect. But if you look at the earnings of Tesla and you see the valuation that people are giving to Tesla, like 10 times bigger than the average car company, or the same size as all the top 10 car companies combined, that's pretty freaking outrageous, okay? I think Tesla's in a bubble. And 10% of this ETF is in Tesla, okay? And then going down the list, you got Roku, Invitae Corp or whatever, CRISPR Therapeutics, Square. 52%, almost 53% of this ETF is in 10 freaking stocks that have recently had massive run-ups. Now, if you've had a massive run-up with amazing gains, there's this thing called reversion to the mean, where performance over the long run tends to be the same for most asset classes of stock, okay? You might have a massive growth in one asset class, or one type of stock or one type of sector, and then the next year you might have a bunch of crap growth or negative growth. And over time, it kind of balances out. Right now, there's been outsized performance in these particular speculative disruptor type stocks, okay? So if you're putting your money in this ETF, just know you're buying a bunch of companies that have recently had massive run-ups, and you're highly concentrated in 10 freaking companies. Now, am I against investing in this ETF? No, I'm not. But you need to understand the real risks. And the real risks are that there could be some kind of pop in this ETF, okay? And you could have some major freaking losses. And if you're not willing to gut it up and not sell, you're going to be screwed, okay? Now, like I said, 53% of this ETF is in 10 stocks, highly concentrated, all right? Now, looking at the sectors. The sectors it's a little bit more diversified because, it's got biotech, software, entertainment, IT services, yada, yada, yada. And that's fine. But if you look at the fund characteristics, I mean, good Lord. Price to books ratio, 9, almost 9.5. Price to sales, I mean, whatever. That's 11. Price to cash flow, 34. Basically, you're paying, let's say for the book, you're paying almost $10 for every $1 of book value of this company, which is the assets minus the liabilities. $10 for $1 of value, okay? That's a pretty steep price. And what that means is investors have priced in massive growth of the underlying stocks in this. Now, what is my conclusion for this ETF? Should you invest in it? I personally don't. I don't like it. I think it's way overbought. You know, it could have a massive run. It could keep going and going and going. I could be wrong. But I'm not willing to risk a huge part of my portfolio in something that is highly concentrated and that has recently had massive gains, okay? Now, if you just have to invest in these innovators, you should only put 5% of your portfolio in any kind of speculative or fun investment. The rest of your portfolio, 95%, should be in total stock market index funds. I like VT, and you can throw in some total bond market index funds or ETFs, all right? 5% is for fun, 95% is the core of your portfolio. That's my thought on ARK, all right? Let me know what you think. Leave a comment, we can talk about it. I know there's been a lot of hype, so I know there's going to be some fanboys that are going to get pissed, or fangirls. But leave a comment, like the video, subscribe. We'll talk, and maybe we can change each other's minds. I mean, you're probably not going to change mine, but maybe. All right? Well, thank you for your time. I'm going to be on later tonight. I'm going live with my hot buddy Jay Nagy, and we're going to have a delicious time dumping on terrible financial advice on YouTube. All right? You guys have a good day. Cheers!